Welcome to the deep dive. Today, we're navigating a really crucial piece of the global financial map. We're heading straight to Luxembourg, a country that, while it's small, is the undisputed nexus for alternative investment capital. We are diving deep into the architecture, really asking the question, why? Why do the world's most powerful private equity firms, massive real estate managers, and sophisticated family offices all choose this one specific jurisdiction to deploy hundreds of billions of dollars?
It's such an essential question because you are basically looking at the foundational operating system of modern finance. This isn't just about finding a convenient mailbox, not at all. It's about structural certainty. Capital flows here because of, I'd say, three core pillars. You've got structural reliability rooted in their legal framework, then predictable and favorable tax clarity, and finally, a deeply mature, specialized service ecosystem that handles immense complexity.
And the interesting part is who is relying on this. It's not just institutional giants, the pension funds and insurers who demand that visible regulatory oversight. Our sources show this infrastructure is equally crucial for private equity sponsors running multi-billion-dollar flagship funds, and maybe most fascinatingly, for family offices. They're using it to centralize these vast multi-jurisdictional holdings for asset protection and multi-generational succession planning.
Exactly. Our mission today is to really pull back the curtain and show you how they manage what seems impossible, achieving institutional-grade governance while at the same time maintaining a surprising speed of formation. And that speed factor can genuinely make or break a private market deal. This jurisdiction has, well, it successfully created the backbone for long-term thesis-driven investment.
So let's start there, at that foundational layer. What exactly is the legal bedrock? I mean, when an institutional allocator commits capital for a decade or more, they need an ironclad guarantee of legal stability. What makes the Luxembourg framework so trustworthy?
The foundation is key, you're right. It's a civil law framework. But what makes it so effective is its seamless integration with the entire regulatory structure of the European Union. They've customized this stability through specialized local investment laws. We're talking about things like the AIFM law, which dictates how managers operate, the SIF law for specialized investment funds, and the RAIF law, which is a more recent innovation for speed. This whole framework just offers stability and, crucially, long-term policy visibility.
That visibility must be paramount for funds with, 10 to 12-year life cycles? But beyond the law itself, you mentioned the service ecosystem. Can you sort of paint a picture of what that support system actually looks like on the ground?
Yeah, global allocators don't just look at the statute books. They look at the quality of the people executing the strategy. And Luxembourg has attracted this deep pool of world-class administrators, depositaries, and auditors. This isn't trivial work. You need administrators who can handle the absolute complexity of capital call mechanics, ensuring investors wire money quickly, and the calculation of sophisticated waterfall models, which dictate exactly who gets paid and when, down to the penny, across multiple currencies all at once. That operational expertise is a massive de-risking factor.
That makes perfect sense. If your complex math is being handled by experts, investors feel safer. And speaking of safety, the sources heavily emphasize the governance edge from these umbrella structures with segregated compartments. What does that idea of ring fencing actually achieve when you're structuring a fund?
Think of it like this. A manager wants to launch Fund 1 in 2024, Fund 2 in 2027, and maybe a specific co-investment vehicle alongside Fund 1. Instead of setting up three separate legal entities, they launch one umbrella fund and Fund 1, Fund 2, and the co-investment vehicle just becomes segregated compartments underneath it.
Oh, like separate vaults in the same bank?
Exactly. That's a perfect analogy. The ring fencing ensures that the assets and liabilities of Fund A are legally isolated from the assets and liabilities of Fund 2. So if Fund 2 gets into some legal dispute or faces solvency issues, Fund A's assets are completely protected. It's a highly efficient way for managers to execute diverse strategies or different vintage years under one cohesive platform.
Let's pivot back to the private wealth side for a second, the family offices. We said they use this for centralization. Can you give me a high-impact example of why a family office in, say, Singapore would choose Luxembourg for consolidation?
Sure. Imagine a wealthy family with a really diversified cross-border portfolio. They might have a stake in a private equity fund based in New York, a major commercial property in London, and a portfolio of liquid securities managed out of Zurich. Managing that through individual holding companies in 3 different countries is, well, it's an administrative nightmare.
Too much paperwork, too many regulators.
Precisely. By consolidating all those assets into a single Luxembourg vehicle, like a dedicated SCSp under a single-family office umbrella, they centralize governance, improve regulatory oversight, and dramatically simplify reporting. Instead of 3 lawyers, 3 administrators, and 3 tax reports, they have one robust structure. This not only improves efficiency, but ensures smoother succession planning for the next generation, because all the assets are governed by one consistent set of rules.
That is a powerful application. And it brings us directly to the structural choice itself. When a manager sets up shop, they face 2 distinct paths, regulated versus unregulated funds. What's the defining difference between these 2 regimes?
The split really revolves entirely around direct supervision by the CSSF, that's the Commission de Surveillance du Secteur Financier, Luxembourg's financial regulator. The regulated funds, like the classic SIFs or SICARs, are directly overseen and require pre-approval from the CSSF before they can launch. This really suits institutional investors, like public pension plans, who specifically need that regulator's stamp of approval for their own compliance reasons.
And the other path, the fast lane, I guess, the unregulated funds.
This is where the innovation comes in, and this is where most of the new private capital flows. Unregulated funds, like the RAIF and the standalone SCSp, do not require direct CSSF authorization. Crucially, though, they still maintain oversight, but it's indirect. They're supervised through the legal obligations placed upon an authorized alternative investment fund manager, or AIFM, the depositary, and the external auditor.
So if speed is the headline, doesn't that raise some red flags? I mean, are managers sacrificing true oversight just for the sake of speed by skipping that CSSF sign-off?
That's the critical question, and the answer is absolutely not. They aren't sacrificing governance, they are shifting the regulatory burden. The CSSF is essentially trusting the AIFM, which is itself highly regulated, to maintain institutional standards. It creates a highly efficient division of labor. Since the RAIF, for example, is reserved only for professional or well-informed investors who are assumed to conduct their own robust due diligence, the regulator can step back from individual fund approvals and focus on supervising the managers instead.
That is a very smart mechanism. And how stark is the actual timeline difference for managers? Because in private markets, speed means winning the deal.
Oh, the difference is exponential. If you go the regulated route, you're waiting for that CSSF review, which can easily take 3 to 6 months. In a dynamic market, that is often just too slow.
A deal could completely collapse in 6 months.
Exactly. By contrast, an unregulated RAIF SCSp platform can be legally formed within a few business days once the legal documents are finalized and signed. Even accounting for onboarding the crucial service providers, the AIFM and the depositary, the fund can be operational in 2 to 4 weeks. Cutting that time to market by 80% or more is the ultimate game changer for PE funds needing to react quickly to acquisitions.
Okay, let's focus on those 2 core structures that deliver that speed and flexibility. First, the RAIF, the Reserved Alternative Investment Fund. Why is this considered the institutional fast-track structure?
The RAIF, which was introduced less than a decade ago, is really modern regulatory engineering at its finest. It gives the fund itself the institutional tax status of a classic SUF fund, but it avoids the bureaucratic bottleneck of the CSSF pre-approval. It just relies solely on that indirect AIFM supervision.
And since it bypasses that CSSF check, what's the suitability filter for the investors? Who can get in?
The filter is strict. RAIFs are restricted to professional, institutional, or well-informed investors. This generally means individuals or entities subscribing to a minimum level of investment, often around 125,000 euros, which acts as a suitability guarantee. And the flexibility is enormous too, because RAIF can be structured as an umbrella with compartments, allowing a manager to rapidly launch a new fund compartment for a new strategy without re-registering the entire structure.
Now, onto the workhorse of private capital. The SCSp, or Special Limited Partnership. We hear this term everywhere. What is its core function, and why is it so indispensable?
The SCSp is essentially the contractual backbone of the private capital industry. It's a contract-based vehicle. It was intentionally designed to be familiar to US and UK private equity houses, mirroring the economic and legal logic of a Delaware or English limited partnership. It's what defines the relationship between the general partner, who manages the fund and takes unlimited liability, and the limited partners, who commit the capital, but whose liability is capped at their commitment.
So the partnership agreement is basically the law of the land, dictating who manages what and how the money flows.
Absolutely. The contract governs everything. The cadence of capital calls, the precise formula for distributions, carried interest calculations, the voting rights of the LPs, everything. Fund managers use the SCSP for their flagship funds, parallel funds, joint venture platforms, and even the specialized carried interest vehicles that house the management team's stake. It can sit standalone, or very commonly, it's wrapped inside a RAIF to gain that institutional tax status.
Which brings us to tax efficiency. It's not the only driver, but without clarity on tax, the whole structure fails, right? Let's talk numbers. What kind of clarity do these structures offer?
Predictability is the key investor incentive here. For the RAF, when it operates under that SIF tax regime, it benefits from a highly favorable status. The fund itself is typically exempt from income tax and capital gains tax. It pays only a tiny annual levy called the 0.01% subscription tax on its net assets. And even that has exemptions, for instance, for funds of funds or funds invested in microfinance. It means capital is preserved at the fund level.
And for the SCSP, that partnership structure.
The SCSP and the standard SES partnerships are the epitome of what institutional investors look for. They are almost always tax transparent. This is the crucial concept. Tax transparency means the profits and losses do not get taxed at the Luxembourg partnership level. They flow through to the partners, as if the partners held the assets directly.
So if I'm a pension fund in Canada investing in a Luxembourg SCST, I only pay tax back home in Canada, avoiding that double taxation.
Precisely. That flow-through mechanism avoids the layers of complexity and double taxation that would just erode investor returns. It aligns perfectly with the tax rules in the investor's home jurisdictions, making it an incredibly clean vehicle for cross-border investment.
And to manage investments internationally, our sources highlighted the use of Luxembourg holding companies that utilize the EU parent subsidiary directive. How does that fit into the whole architecture?
Right, so when a Luxembourg fund wants to buy an operating company or make a major infrastructure investment in another EU country, the fund will often insert a Luxembourg holding company between itself and the asset. By utilizing the EU directive and Luxembourg's expansive network of over 80 tax treaties, they can significantly reduce or even eliminate withholding taxes on dividends, interest payments, and capital gains flowing back up from the portfolio company. It's how complex, multi-jurisdictional investments like leveraged buyouts are executed cleanly.
Let's move to the governance architecture. We've established that robust controls are mandatory, even for these fast-track unregulated funds. Can you detail the core pillars of oversight required that reduce that operational and governance risk?
There are 4 non-negotiable roles. First, the AIFM, the manager, is responsible for executing the investment strategy and, critically, for monitoring the risk profile of the portfolio. Second, the depositary. This is the independent asset watchdog. Their job is to safekeep assets and strictly monitor the fund's cash flows, ensuring funds are not misallocated or, used fraudulently.
And the administrative and reporting duties, who handles all that?
That falls to the central administrator. They handle the complex work of calculating the net asset value, or NAV, maintaining the investor registry, and fulfilling all regulatory reporting duties. And finally, you have the independent external auditor who reviews the annual accounts and confirms that the valuation policies, which can be contentious in illiquid assets, are being applied fairly. This whole disciplined architecture is what assures investors that the controls are in place.
And who actually makes the high-level investment decisions approving deals or major exits?
That typically rests with the general partner's investment committee or sometimes an advisory board. These groups approve the key deals, the material exits, and decide on leverage levels. For those family office structures we discussed, these committees adapt. They often include trusted, non-family advisors and significantly active members of the next generation. This ensures that the expertise remains high while integrating the rising generation, which is crucial for long-term continuity.
Okay, let's quickly map these structures to real-world deployment. How are different asset classes using this flexibility?
For private equity buyout and growth funds, the gold standard is the closed-ended RAI SCSP structure, usually designed for a 10 to 12-year life. Real estate managers, on the other hand, heavily favor standalone SCSP partnerships that hold special-purpose property companies across Europe. For venture capital, which needs even more flexibility around follow-on investments and valuation, they might lean toward the specialized SICAV regime, or a RAF.
And for massive institutional allocators who are diversifying their exposure,
They often use RAIF umbrellas for fund-to-fund strategies. They can easily separate their capital into compartments, one for UFPE, one for European real estate, and one for infrastructure, all under the same legal entity. It just optimizes efficiency and reporting. The common denominator is always the desire for a predictable, scalable platform.
This has been incredibly clarifying. For you listening, the key takeaways really focus on the practical competitive edge that Luxembourg provides. Let's just distill the most critical points.
I think the combination of speed and regulatory certainty is the differentiator. You get fast formation just days for the RAIF SCSp platforms, which is essential for deal flow. You get incredible flexibility through the partnership contracts, allowing for bespoke waterfalls and complex co-investment rights. The tax side offers predictability, highlighted by that minimal 0.01% subscription tax for many RAIF structures. And perhaps most importantly, you achieve powerful governance that aligns perfectly with global institutional standards, thanks to the AIFM and all those independent controls.
So, Luxembourg isn't just an accessible gateway to European investors. It's the stable anchor, the operational engine room for global private capital.
That's precisely right. For fund managers, it's the proven backbone for structuring capital from the first close to the final distribution. And for private wealth clients, it provides the legal insurance policy and the cross-border stability required for multi-decade generational planning.
That structural reliability is clearly why private capital has centralized there. But it does raise a final thought for you to consider. Given the inherent appeal of operational flexibility and guaranteed tax transparency in contract-based vehicles like the SCSp, how did the ongoing global evolution toward tax harmonization efforts, things like global minimum taxes, impact the current landscape of specialized tax-exempt investment vehicles like the RAIF over the next decade? Will regulatory innovation be able to keep pace with the drive for global consistency?
That is the tension defining the future of finance. It's going to force jurisdictions like Luxembourg to continue innovating their governance and substance requirements to justify their role, proving that they offer more than just a tax advantage. They offer indispensable legal and administrative substance.
Absolutely. Thank you for guiding us through this crucial deep dive into the architecture of the alternative investment world.